Welcome to Market Shock Brief. In the financial markets, major storms rarely appear without warning. Today, we're revealing 5 critical signs that a market crash could be just weeks away. These are not hypotheticals. They are signals that have preceded some of the biggest crashes in history. Understanding them is your first line of defense. We'll examine each sign in detail, providing the historical context and the current data you need to see the full picture. Don't be caught unprepared. This is essential viewing for any serious investor in today's volatile climate. A market crash isn't a random event. It's a chain reaction, a loss of confidence that feeds on itself. We're going to break down the key economic fault lines that are showing stress right now, from the bond market to the real estate sector. Each sign is a piece of a larger puzzle. When these pieces fall into place, the resulting picture is one of extreme risk to your portfolio. It's crucial to recognize the pattern before the final domino falls. Our first and perhaps most reliable sign is the inverted yield curve. Normally, long-term bonds have higher yields than short-term bonds to compensate for risk over time. This upward slope is the sign of a healthy economy where investors expect growth and inflation in the future. But sometimes this curve flips upside down, and that is when the alarm bells should start ringing for every serious investor. It is a powerful predictive tool that few understand, but its message is almost never wrong. When the curve inverts, it means investors are so pessimistic about the near-term future that they demand a higher yield for holding a short-term bond than a long-term one. It's the bond market, often called the smart money, screaming that a recession is coming, and recessions almost always bring a market crash with them. This signal has a nearly perfect track record, predicting the last 7 recessions without a single false positive. It is financial bedrock, a warning written in the language of interest rates. This exact signal flashed red before the 2008 financial crisis, the dot-com bust, and nearly every recession for the past 50 years. When the 2-year Treasury yield rises above the 10-year, the clock starts ticking. It is financial bedrock, and it is a warning we cannot afford to ignore. The historical precedent is too strong to dismiss as a mere coincidence. The pattern is clear for those willing to look. Sign number 2 is extreme market valuations. When stock prices become completely detached from their underlying corporate earnings, the market is on thin ice, floating on a bubble of pure speculation. The best measure for this is the CAPE ratio, developed by Nobel laureate Robert Shiller. It provides a long-term perspective on whether the market is cheap or expensive relative to its own history. This isn't about short-term timing. It's about assessing long-term risk. The cyclically adjusted price-to-earnings ratio, or CAPE, smooths out earnings over 10 years to get a clearer picture of market value. When it soars past 30, as it did before the dot-com bubble when it exceeded 44, it signals a dangerous bubble. Today, valuations are once again in this warning zone, priced for a perfection that simply may not exist in a fragile global economy. The air is getting very thin at these altitudes. Gravity is a powerful force in financial markets. Warren Buffett's favorite indicator, the ratio of total stock market capitalization to GDP, tells a similar story. When this percentage is significantly above its historical average, it suggests the market is overvalued and a correction is likely. Today, we are well above the historical norm, indicating that investors are paying far more for stocks than the underlying economic output would justify. This divergence is unsustainable in the long run. Sign number 3 is euphoric investor sentiment. As Warren Buffett famously said, "Be fearful when others are greedy." When everyone believes stocks can only go up and your taxi driver is giving you stock tips, that is often the moment of maximum financial risk. It's a classic sign of a market top, where the last buyers are retail investors who are about to be left holding the bag. Euphoria is the enemy of the prudent investor. One key indicator is the VIX, or the fear index. When it's unusually low, it signals widespread complacency and a lack of hedging in the options market. The calm before the storm is often the most dangerous time for an unprepared investor. Smart money sells when there is no fear and buys when there is blood in the streets. A low VIX is a sign of a market that has forgotten how to be afraid. At the same time, watch for a surge in retail buying, often in speculative high-risk stocks, while corporate insiders, the people who know their companies best, are selling their own stock at a record pace. The divergence between smart money and retail is a massive red flag. Always watch what they do, not what they say. The insiders are signaling their exit. Sign number 4 is soaring debt levels. In the last decade, both corporate and national debt have ballooned to unprecedented levels, far exceeding the size of the economy. This makes the entire global financial system incredibly fragile and vulnerable to shocks. The corporate debt-to-GDP ratio, for example, is now significantly higher than it was just before the 2008 financial crisis. The system is leveraged to the hilt, with no room for error. When central banks are forced to raise interest rates to fight persistent inflation, this mountain of debt becomes impossible to service. This can lead to a devastating wave of corporate defaults and even a sovereign debt crisis, dragging the entire market down with it. It's an inescapable trap that has been set over many years of easy money policies. The bill is finally coming due, and it will be paid one way or another. A key leading indicator within the debt market is the spread on high-yield junk bonds. When the premium to hold risky corporate debt widens dramatically, it means credit risk is being taken seriously again, and the financial plumbing is starting to seize up. It's a sign that the foundation of the market is becoming unstable. This is a critical signal that professional investors watch closely. Finally, our 5th sign, cracks in the housing market. The health of the consumer and the banking system is often tied directly to the value of real estate. For most families, their home is their single largest asset. As we saw in 2008, it is the ultimate canary in the coal mine for the broader economy, with devastating ripple effects that can trigger a systemic crisis. It is a critical indicator of consumer health. Watch for a toxic combination of soaring mortgage rates that crush affordability, a rapid increase in the number of homes for sale as sellers rush for the exits, and a sudden drop in sales volume as buyers can no longer afford to enter the market. This was the exact pattern we saw before the 2008 crash. The data points are all trending in a worrying direction once again. The Housing Affordability Index is a crucial metric. When it plummets to record lows, it signals that the market is overheating and is sustained only by loose lending standards or speculative fervor, which is a recipe for disaster. A correction in housing often precedes a correction in stocks as the wealth effect goes into reverse. This is a key danger zone for the entire economy. Individually, each of these signs is a major concern, but when you see all 5 flashing red at once, an inverted yield curve, bubble valuations, investor euphoria, record debt, and a shaky housing market, a major correction may be unavoidable. The weight of the evidence becomes overwhelming, suggesting that the question is no longer if, but when. The risk is palpable and should be taken seriously by all. No one can predict the exact day or hour a crash will happen. The goal is not to time the market perfectly, which is impossible, but to understand the elevated risk and have a defensive plan in place. This is about risk management, not fortune-telling. Being prepared with a diversified portfolio of resilient assets is your best defense against the coming storm. This is a time for caution, not panic. For more in-depth analysis on how to protect your portfolio with hard assets and other defensive strategies, make sure you subscribe to Market Shock Brief. Stay vigilant, stay informed, and we'll see you in the next report. Thank you for watching. Click the link below for more information on building a resilient portfolio. Our goal is to keep you ahead of the shocks.